So the balance sheet. What is the balance sheet? How does this relate to what we're actually doing? Well, the balance sheet really reflects the overall health of an organization. So let me give you an analogy. We just covered the income statement. So the income statement is about profitability. Remember, profitability over a period of time. But it's like a grade in a class. So when you think about the balance sheet is broader. It has a little bit more substance to it in a sense. And it's like your overall QPA. So, and it really is in the overall financial health of the organization. So that's how those two relate. And the balance sheet pulls a number of elements from the income statement. And we're going to talk about what those are in just a few minutes. But first, let's talk about what's in the balance sheet. So what does it mean? Well, a balance sheet, if I can do this, it has to balance. So there are two parts to the balance sheet. Now the balance sheet, the basic equation is you take all of the assets, so we have our example here, we take all of the assets of the organization, and we take those assets and sort of draw an equal sign, and then we take our liabilities plus our shareholders' equity, and those two have to balance. So in reverse order, we take shareholders' equity, we take equity plus liabilities, those equal assets. So another way to think about this is really we take everything that what an organization owns, and we subtract from it everything that an organization owes, and then it equals what an organization is actually worth. So owns minus things that the organization owes equals what an organization is worth. So it's another way to kind of think about the balance sheet. Maybe it's a little bit more understandable from that perspective. But let's talk about really the components. So on here what we have is assets of the organization. And on a balance sheet, the most liquid assets, those things that can be turned into cash, are really at the top. So the most liquid at the top, least liquid is at the bottom. So assets. So what are assets? Well, we have things like cash. Obviously, cash is an asset to any organization. We also have things called, this thing called accounts receivable. So what's accounts receivable? Well, accounts receivable is money that other people owe us. It's that promise to pay. So think about accounts receivable is, hey, we need to collect that money because we're going to convert that money that we receive into actual cash. So we have accounts receivable. The next item that we have is inventory. Well, inventory is an asset, but it's kind of a two-edged sword. So inventory, if you walk into a warehouse, and the warehouse is full of boxes, and it's full of all manner of goods. There are three different kinds of inventories. There's raw material, it could be like plastic. You can have inventory that's what's called work in progress, stuff that's being made. And then you have finished goods. It's, hey, cars in the parking lot if you were General Motors. So there's three different kinds of inventory. So inventory, even though it's counted as an asset, there's some interesting downsides to it, but we're going to get to that in just a moment. So we have inventory. And then we have things that are property, plant, and equipment. These are also things that are assets to the corporation. And so we add all that up. That's all that stuff that we really own in the organization. So now we're going to talk about the liabilities. So liabilities, the opposite of accounts receivable, is accounts payable. This is money that we owe to other people. And in our liabilities, what's kind of interesting, there are things called accruals. So we accrue for certain things. Now for HR people, one of the things that we may not think about all the time, but remember we talk about vacation accruals? Those vacation accruals actually hit the balance sheet as a liability. So one of the things that we need to think about, maybe part of your project is like, hey, if we want to, how do we reduce the liabilities of an organization? Interesting enough, is for people to take their vacation. So one of the ways that HR people can actually help an organization is to really make it easier for people to take their vacation time, because it reduces that liability actually on the book. So there's a lot of other different kinds of liabilities. There's debt that an organization has. They're borrowing money, and you have to service that debt. We saw it on the income statement. If you remember that line, there's an interest line. It's the way that that gets accounted for. So there's a lot of different things that go into this. Again, not trying to be too detailed on it, but let's go to this last component, which is equity. So what is equity? So some people think about equity as really sort of stock. Well, in some ways it is, but really what it is, it's actually the amount of money, if I reach in my pocket, it's actually the amount of money that the original owners put into the organization. But it's also the accumulated profit. So it's also, equity is also called retained earnings. So that amount of money, that profit piece that comes from the income statement, really flows into the balance sheet as retained earnings. Now, I'm going to show you a graph on how these two, the income statement and the balance sheet, actually relate to each other. So here's the graph that I mentioned to you. Look at the way these two major reports interact with each other. In very simple terms, the revenue from the income statement comes over to the balance sheet in the form under assets, and it goes into accounts receivable. In this case, we're just using $100. So we've made a sale, we've sold some training, or we've sold some markers, and we're now going to invoice the customer. That invoice comes into accounts receivable. Remember, this is only a promise to pay, so we don't have this money yet. Now, from an expense standpoint, we've had some expenses. It could be direct expenses or indirect expenses, but we've had some expenses that we needed to incur in order to generate this revenue. So those expenses really come over into accounts payable. So we have to pay for the lights, we have to pay for the carpet, we have to pay out. That is money that we owe to our vendors. Now the last thing is profit. So that profit that we created between the $100 and the $80, we generated $20 worth of profit. That profit comes over into our balance sheet in the form of retained earnings. So when I talked before about these two things balancing out, so we have our liabilities, $80, equity, $20, that's $100, balancing against our accounts receivable or our asset side of $100. So I know it's a very simple example, but it really is, it isn't all that much more complicated than that, at least for the case of what we're the point I'm trying to get across to, is that these two things relate to each other. And but let me take it a step further. Let me talk about accounts receivable for a moment. So accounts receivable, we want this number to be both high and low. And what do I mean by that? We want to actually have a lot of accounts receivable because that actually relates to revenue. So we actually want that number to be fairly high. So, but we want it low, and I'm going to switch terms on you. We want to be able to collect that money in a very short period of time. So we want to collect it, say, within 30 days. So we want a high amount, and we want to collect it very quickly. Now, when it comes to accounts payable, we want that number to actually be low, but high. So we don't want to owe a lot of money. And the money that we do owe, we want to pay it slowly. So we actually want to pay our bills slower, in a sense, than what we actually receive money in. So if we receive money in 30 days, and we pay our bills, say, in 45 or 60 days, that really enables, that helps our cash flow which is something that we're going to talk about in just a bit. The other thing I want to mention on the asset side is inventory. Remember, inventory is kind of a two-edged sword. Now, inventory, when you walk into that warehouse and say, wow, we got a lot of stuff in this warehouse, what's happening with inventory that you need to be aware of as a good financial steward is that inventory is tying up cash. Unless we're selling all of that stuff in the warehouse, and we're selling it quickly, that money is tying up cash that we could actually buy other stuff for. If we need a new computer system, new HRIS system, new trucks to deliver pizzas or whatever it might be, we might have, it might look like we've got a lot of assets on our books because we've got a lot of inventory, but we don't have the cash for it because it's tied up in this inventory that we may or may not be selling. So one of the things you want to think about, especially if you're in a product company, is take a look in your warehouse and say, whoa, does this seem to be the right level of inventory for the amount of sales that we're actually creating? This might be a point of maybe one of your project is like, how do we sell more products? Another aspect that might want to think about when it comes to accounts receivable is that how do we enable us to collect that money quicker? So if you think about why don't people pay their bills? People don't pay their bills because maybe the product that we shipped them was defective. Or maybe the bill that came to them was wrong. Maybe it was late. Maybe it had the wrong numbers on it. So you want to think about quality affects receivables, the time that it takes us to really collect the money. So any kind of effort that you put in your project to enable billing to be more accurate and effective, products to go out more accurately and effective, those things are actually create value for the organization. And you're much more able to sell your project if you're going to create that kind of positioning within your organization. So, quick review. Remember that the balance sheet and the income statement are interrelated. An income statement is as of a point of time and its profitability. A balance sheet is over a period of time and it shows overall financial health, grade versus QPA. Assets equals liabilities plus equity. And equity, we talked about assets enough. Assets, everything that a company owns. Liabilities, everything that an organization owes. And equity, everything that the company owns. So, we continue to set the foundation, our financial foundation here. The next thing that we're going to talk about is cash flow. That's our next stop.